Well, it gives me great pleasure to bring on board a very old friend of mine, a market veteran and a very well-wisher of ET now, Sundeep Sikka of Nippon Asset Management. Sundeep, fantastic to have you back. The bull market is in its full bloom and you've been hiding, you've not been coming on the channel.
It's always a pleasure to be back. And I think many times it's good to see the bull market from away and I create wealth for investors. And it's been one of the most satisfying 12 months. I think when exactly last year, same time, I think we were at the worst period when the Nifty was 7,500. And today, as we talk, things are at an all-time high. So thanks for inviting me.
Sandeep, it's quite ironical that FI flows at a record high, retail participation at a record high, number of demat accounts open in last 1 year is about 1 crore. But if I look at inflows into mutual funds, and I'm keeping the SIP picture aside, we'll talk about it. If you keep the SIP picture aside, the flows into equity schemes have not been very resilient. Why is that?
Because you're right. I mean, these are very unusual situations. Markets at all-time high, demat accounts opening at all-time high. But I think one needs to slice the onion and see the data a little differently. I think if you were to look at it, whenever in past also, let me go back to financial year 13, I think when we saw a bull run, we saw investors redeeming and we saw the longest stretch of 9 months back-to-back outflow. Somehow this time, I feel while on one side we see the outflow, but the quality of the industry and the investors is improving. And I'll give you some data points. While I think we clearly see a lot of outflow, but the fact remains as an industry during this entire period of last 12 months, we have added about 70 lakh new investors. The SIP flows continue to be high, but more importantly, the new SIP registrations continue to be high. The trend that we are seeing is very interesting. I think it's in the HNI segment is the one which has been regularly redeeming as the markets go up. And it's bound to happen when the markets go up so sharply, almost they've doubled from the bottom. I think you will see investors, redeeming and booking profits. But there's also a very interesting trend since you touched about demat. I think I clearly see this is the best time for India where we're seeing consolidation of the capital, strong foundation for the capital markets getting built. You are seeing 1 crore new demat account holders. You are seeing 70 lakh new investors coming into the mutual fund industry. What it does is effectively, it's always been the vision that I think we need more household saving into the capital markets. And we're just getting ready for that. So I personally believe, let's not see just the top line number of the outflow, but the quality point of view, we're in a far stronger position than we were ever before.
How much of the current outflows into mutual funds could be a factor of two? One, a strategic call by funds that they want to raise cash because markets are at an all-time high, and repositioning of the balance funds which had invested into equities same time last year when markets were low.
Well, I think it's a mix of both. I think last 12 months have also taught us, let me start as professional portfolio managers. You have to always be ready for anything can happen. I think nobody expected the kind of sharp correction that we saw. So today, I think as the markets are going up, fund managers have also been building up a little cash position. So that is one. B, there has been a clear two trends that have emerged. One is the advisors and investors have been booking profit. But there's a third trend which has caught up during this period. While we saw a lot of money moving out of large cap funds, and this, if you were to look at the data for the last 2 months also, we have seen a lot of inflow coming into ETFs. So effectively, investors are getting matured. So if you were to divide the investors in two categories, the savvy investors who are taking calls are moving into ETFs, and you have the retail investors, new PANs getting added to the industry. So it's a mix of multiple factors, but it's clearly, I remain very excited. I think we're building a very strong foundation for the industry as well as for the Indian capital markets.
Foreign debt investors, Sandeep, this is a terrible time because if at all interest rates will move higher, if at all interest rates will move higher. So while debt funds give you this cushion and it's important for asset allocation, for an investor who always has been on the right side of the debt market for last 2-3 years because of decline in interest rate, now the tide has changed completely.
I can't agree more. I think our industry is always very exciting. I think if things are going good in equity, last 3 months we have seen as the 10-year moving from 590 to say almost going up by 30 basis point, investors have seen negative returns in fixed income. But that's the reality. That's how the portfolios will always have, the asset allocation has to be done. The whole of last week, I was seeing a very interesting trend. While the equity markets were negative, when I looked at my own portfolio, it's only the international funds which are positive. So I think portfolios will have to be created in a very even manner. I think you need to have a mix of everything, debt, equity, and international funds. And also, I think one thing that is emerging is, again, coming back to your earlier question, investors now do not panic the way they used to do earlier. I think clearly, we have seen last 3 months, fixed income giving negative returns, but investors take it in the stride because you're not investing for a period of only three months. So let me give you another example. Recently during the budget, I think we saw the voluntary provident fund getting taxed. We had a product long time back, Nivesh Lakshya, which is basically an average maturity of about 20 years. Now, all of a sudden, you see investors coming into that fund because they see there is an opportunity to stay invested for a longer period of time. So I think investors are evolving, I think, and for us as asset managers, the key lies in offering the right products and let the investor make that choice.
Okay, if I look at the mutual fund landscape in India, it was brutally comparative. India is one country where domestic mutual funds have done much better than global mutual funds, and Nippon Asset Management is the only exception to the rule. How did that happen?
So thanks, Nikhil. Thanks for the compliment. I think from our perspective, I think the way we see, while I think we are a multinational, Nippon is the world's largest life insurance company. But at heart, I think if you see, we are trying to run the business in a very Indian manner, what is right for the Indian investors. At the same time, I think over the last 18 months, as we have gone through this rebranding, we are, and relaunching, if I can use the word, we are trying to get some of the best global practices in risk management from Nippon Life, but still continuing with what is right for the Indian investors. From our perspective, if I was to look at it, since you talked about our journey, I think traditionally we were only a pure mutual fund play. Going forward, you see us divided our business within 4 different verticals. On one side, you'll have mutual funds, and mutual funds again divided between active and passive. And passive, just to highlight the fact, today we are about, when I look at our equity sets, 1/3 of our assets are in passive now. On the other side, I think we are already started building up our international offshore business. Third is the venture capital funds. We have launched a digital venture capital fund in Japan and also 2 real estate funds in Japan. So it's a very interesting, the business which was only purely a mutual fund play, now going forward will become a complete true blue asset management company.
Okay. Given that every week now, first it used to be one name in a quarter or 2 names in a year. Literally every week I'm getting 2 or 3 names which possibly want, of companies or financial firms which now want to start asset management businesses, whether it is Paytm or some names which we both know. How do you see that changing? What, you got a space where only top 4 or 5 players are making money, and there could be entry of tech dominated players, about 4 or 5 them later this year.
So this is a very interesting point. I think if you were to look at it, at this point of time, only 2% of the population is investing in mutual funds. So I think we really welcome. I think we need more mutual fund players. In US, there are 4,000 asset management companies. From our perspective, the way we see, the new players help in increasing the base and going deep into the market. But again, what's very important is we need to identify that every asset management company will have its own strength. Somebody will be coming in digital, somebody is going to be working only on ETFs, somebody is going to be working for HNI, so it's going to be a niche, a lot of new niche AMCs will come. Digital, I think I clearly believe digital is going to be the way forward. For us, even though we are a traditional asset management company, 52% of the business that we do right now is through digital. We have about 30 integrated APIs with some of the names that you took and many more smaller players. I think it's interesting how digital changes everything. I remember, Nikunj, I think over the years when we were all making as industry SIPs popular, it used to take 5 days to convince an investor to invest into a SIP. Right now, through our own digital properties, Nippon Properties, every minute 5 new SIPs are signed up. Every minute on Google, 11 people are searching for Nippon Mutual Fund. Things are changing fast. And today, the only way to remain forward is you need to be agile. I think it's not digital versus physical. I think both will coexist. And it's not only the new fintech companies, it's going to be the traditional companies like us who are converting itself into more a digital play that will also play a very big role. But to your point, more AMCs is good for the country, is good for investors, more choice, and it keeps everybody on toes.
Now, when
One
ETF,
more thing, Nikunj,
I mean,
like
you
to
are
add,
one fund house which perhaps has the highest. Yes, please.
one more thing I like to highlight, especially when we see a lot of new AMCs coming up. I think AMCs are ultimately, it's a volume game. It's very important for every AMC to understand that I think you need a minimum critical mass for you to remain viable. The earlier example that you took of a lot of foreign AMCs which could not do well in India, the critical mass could not be achieved. So I think this is a business which is of operating, there's an operating leverage. I think today for us, let's take our own example. I think over the last 18 months, as we are going through the rebranding, our own mutual fund assets, which have gone to as low as 1,80,000 crores, they are now over 2,30,000 crores. The cost remains the same. The operating leverage comes to play. So I think this is a business of volume. So until the time an asset management company is not able to build up that volume, I think it remains loss-making, and that has been one of the reasons of a lot of exits from India.
Sandeep, as a AMC, I think you have the highest range of ETFs. There is no other AMC which gives this kind of a range of ETFs. Now, ETF is one product. We've spoken about ETF, how ETFs could be part of everyone's financial planning. But from an AMC standpoint, this entire move from active to passive, how do you see that changing in this decade? And if that move is strong, then what happens to the profitability of an AMC? Because in an ETF, you're not going to be making that much money. AMCs will obviously get a better advantage if there is a growth in active versus non-active.
Very good question, Nikunj. I think, Nikunj, from our perspective, way back in 2016, I think as a plan to be future ready, we identified that ETFs will become big in India. If it had become big across the world, there was no reason why investors will not look at ETFs. And I think our call was right. I think we are one of the largest. If you were to exclude the government allocation, which is from EPFO to some of the asset management companies, we have 35% market share. We are 70% of the volume on the stock exchanges. I think the way we see it is, I think our job is basically to provide what is good for the investor. And if the investor chooses to go towards ETF, I think we see ourselves offering those products. And the way we saw this opportunity way back in 2016 is whether if we don't do it, somebody else will do it. Coming back to your question, yes, the profitability on ETF is less. But again, we do not run the business thinking what is more profitable for us. But I think you have to keep the investor in the center, what is good for him. But if I was to flip this question the other way around, while the profitability is low, if you look at the basis point, but in absolute term, so today for us, roughly, if we see, we are about 35,000 crores in ETF. Even at 10 basis point, I think it adds about 35 crores to the profitability. Now you look at it, if we did not have this, we would not be having this 35 crores of profitability. Now let me flip it the other way around. I think today, this does not mean if we have ETF, our active is not important. We run these as two different business units, active and passive, both coexist in the company, will coexist in the portfolio of the investors. And one of the trends that I see is the large cap funds will be the first one to be challenged by ETFs. And if you were to see in one of the business publications today, if you were to look at the top 5 large cap funds, 2 are ETF. So I think for us, the idea is to be future ready. I think we do not want to put our profits ahead of the investor interest. But from a long-term point of view, going back to the earlier question, AMC industry is a volume game. I'll be more than happy. Today we have a blended yield of, let's take 52 basis point. I'll be happy even if the volume doubles from 2 lakh crores, we go to 10 lakh crores. Even if the basis point goes down to 5 basis point, does not matter.
When I speak to some of our common friends, some of the peers, they tell me that the move from the distributor to the direct platform is large. I mean, what an option which perhaps did not exist 10 years ago. Now there is a huge growth and there is a huge change. Now, while Indian investor, thanks to communication and the forums which we've created, is getting much more aware of their financial planning, from an AMC standpoint, if the move is from distributor to direct, is that more profits or for you nothing changes?
So, Nikunj, I think for us as the AMC, nothing changes. As per the SEBI rules, I think whenever an investor comes direct, the distribution commission is passed on to the investor as a lower expense. But again, I think while this move has been prevalent, and again, I'll try to link it back to the earlier question, a lot of changes, the shift that we have seen is more in the HNIs. A lot of these investors who are taking their own calls. So again, you will have investors moving direct, the family offices moving direct, but the retail investor, even today, is trusting its advisor. I think when I look around in my friends, my family, everybody has their own trusted advisor and they continue with them. So I think it's not going to be with the direct coming in, people are going to move. And I would rather add a word of caution. Anybody who's moving direct needs to understand, I think, the risk associated with it. As we talk today, Nikunj, I mean, exactly 1 year back, things were different. But today, I think biggest risk I see is when all equity funds are giving a return of 70, 80%, people are coming with very high expectations. So I think for me, I think that hand holding that the advisor or distributor does is very, very critical. And also, I think a lot of demat accounts which were opened during this lockdown period, a lot of these investors who have seen the one-way market are direct investors. Again, I see these investors also. I hope the going goes good. But I think you'll see a lot of these direct investors who may not be as technically savvy as they think they are. I think they may lose money. And I think that's where the need of the advisor and distributor will be felt.
These are days of extra scrutiny. Data is available on platforms. And a scrutiny which every time fund managers on the equity side have to go through is that why they have not managed to beat the benchmark. How would you defend that?
Well, I think it's a very, very, pertinent question. I think today it's coming to a point effectively, it's not very easy. And specifically, and I use the word, I'm sticking to large cap, it's not going to be easy to beat the benchmark. If you were to go back to 2018-19, even before the meltdown happened because of COVID, the entire rally was so concentrated in 5 to 6 stocks, and it was practically impossible for fund managers to beat the benchmark. But again, I think the way we see it, I think there are on one side, you have investors who really want that absolute return. They are going to mid cap and small cap funds. In large cap, these investors have gone, and that's the reason we have seen the emergence of passive and ETFs. So investors are maturing. I mean, people who are going for too much scrutiny, they have also are moving towards passive funds. And this is a trend that this will continue. And this is exactly the reason why I said, I think we have to live with the reality. There will be investors who will always be doing that scrutiny, who will be questioning the returns, who will be questioning the expenses. And for these investors, they will move towards ETF and passive. And I think from our point of view as Nippon, I think we are ready for that.
How far away are you from reaching that critical mass where your expenses, they remain fixed and additional business adds to the operating leverage? Because as you will grow in size, one is inflation and second is the economy, your return ratios will dramatically change because your fixed cost, which is admin cost, fund management cost, that is not going to grow. I'm just breaking it for our viewers. How far are you from that critical mass where incremental change will be a big change in your profitability?
So Nikunj, if you were to look at the results for the last 9 months, I think it's already showing our OPEX has been coming down. I think effectively it's come down from 34 basis point to nearly, it's at 21 basis point. And within the OPEX also, 50% of the cost is employee cost. That also remains constant. So I think clearly, I think we are at that critical stage. For us, there are two parts. Over the last 2-3 years, we lost some market share for some reasons. I think as that recovery is happening, it's already adding to their operating leverage. And also, as I mentioned, the other verticals, whether to do with the venture fund that we have started, the real estate fund in Japan, and the offshore money that we are targeting, I think all those will add to the operating leverage and add to the profitability.
Sandeep, I've been tracking the mutual fund industry with a magnifying glass, and when the transaction of Nippon Asset Management went through, my first reaction was that, okay, will this open floodgates of Japanese money and global money on the offshore front? Now, the offshore scheme is growing, but it can grow faster. I mean, your reach is there, your distribution is there, your experience is there. Why is that you've not been able to scale it up dramatically and significantly as everybody expected when the formal deal was announced?
So, Nikunj, I think if you were to look at it, the deal was announced in October, November of 19. And I think by the time we were stabilizing, I think in February, again, the COVID started. The last 1 year, the world has been fighting their own problems. So I think clearly there has been a lot of work that has been happening. I do not want to give a futuristic statement, but clearly you will see a lot more flow coming not only from Japan, but from the global network of Nippon Life in days to come. And also the fact that what we talked about, the private equity fund, which is a startup fund, is basically a joint venture. I think it's basically between Indian government and Japanese government, where I think the Development Bank of Japan, Mizo Bank, Toshiba, Maruti, all of the LPs have come. This has come because of Nippon Life, and we are working on a couple of other such deals.
Closing comments, Sandeep. Zerodha disrupted the entire brokerage industry. Do you see a similar kind of a disruption happening? It may not happen at the AMC end, but at the distribution end?
So I think the way I see it, I think Zerodha is a classic example. I think it has disrupted the broking industry. I think from our perspective, Zerodha can disrupt not only the broking, but also the mutual fund industry. And the reason why I say this, and I'm not talking of a name, it's going to be very important for all asset management companies to understand digital is emerging as an important pillar. We ourselves have created a separate vertical for digital. Today, 52% of the business that we are doing is basically through our digital properties. And going forward, whether Zerodhas or others, I think we see them all as allies. I think we'll all see a great opportunity to work together. I think when we talked about demat accounts, Zerodha and others, I think today that's one of the biggest opportunity even for ETFs. So let me give you an example. I think you talked about the name change happened, and I think let me give you one of the biggest positives in the last 18 months. In this financial year till date, I think we have added about 5 lakh new investors in ETF, and this number used to be negative for the year before that. And why this is happening? You are seeing a lot of new brokerage houses coming, new investors coming, and these investors are coming in ETF. So I don't see any of these changes as disruptions. I see these as opportunities to work together. And clearly, we are not in a world right now where it is going to be this versus that. It's not going to be physical will stop and it's only going to be digital. It's going to be a mix of both. And clearly, I see a very big opportunity. We'll see higher penetration in Indian mutual fund industry because of the digital work that is happening in distribution industry.
All right, Sandeep, pleasure to have you. And let's hope that we see much more of you going forward. I was looking at data. It's been almost a gap of more than, a year. So I certainly hope in 2021 we see much more of you.
Sure. Thanks, Nikunj. Always a pleasure talking to you. Thanks for inviting me.